What do you make of the way in which we've lined ourselves up for earnings season?
Well, look, I think we're sitting at a point in the year where we've done a lot of work and valuations have seen a decent amount of pain since January. And I think it's less about what's the right valuation for these stocks to be at. And it's more about what are people actually willing to pay for them, knowing that we have not solved all the problems that still lie ahead, and knowing that we still have a pretty uncertain geopolitical backdrop. We're coming up on midterm elections. We've got all the classic kind of market signals that are saying a recession might be coming. Those are all going off. So there is still a decent amount of uncertainty ahead, not to mention that just the month of October, despite this rally, we've seen almost half of the days with a more than 2% swing in the S&P 500. That is a lot of volatility, and a VIX that's still hovering around 30 also indicates to me that the next few weeks are going to be bumpy.
And what's wild is the volatility in the stock market is basically nothing in comparison to the volatility we've seen in the bond market and the FX market. And I'm interested in those correlations because, for example, today's trade, we saw stocks rally and tech do well because bond markets rallied and yields pushed lower. Is that the sort of correlation we're likely to keep on seeing?
Well, on a day like today, I think it was very much a rate story. So we got some housing data early in the morning, about 9 a.m. Eastern time. And if you just look at the tape and how things moved throughout the day, that 9 a.m. release of home prices coming down pretty sharply is what I think sent 10-year yields down. It sent 2-year yields down. And everybody got sort of excited that, oh, it's working. Inflation is going to go away. And then stocks rallied on the other side of that. Also, though, you want to look at the fact that not just tech rallied, but high beta stocks rallied. And that's not necessarily something that I would expect to be lasting in an environment where we have, in my opinion, more than a 50% chance of a recession in the next 6 to 12 months. So it really was a very risk-on trade. It was sort of this, oh, it's a big relief. We might get a solve on the inflation problem. It might be sooner than we think. But the issue is that once that boulder starts rolling down the hill, it's really difficult to stop it at a certain point and not go into contraction territory.
To that end, of course, with basically all the market moves kind of being dictated by bad news being good news, the Federal Reserve perhaps not hiking quite so much as we'd expected. How much of a dollar story is this all going to be? Are we likely to see, are we now at peak dollar? This is hugely important to a lot of the micro stories, for example, a Microsoft that had highlighted the headwinds of a strong dollar.
Yeah, I mean, look, we've thought that we were at peak dollar. And when I say we, I mean just investors at large. I think there have been a lot of people who thought we were at peak dollar earlier this year. So I don't know if this is peak or not. Regardless, even if it is technically peak, that doesn't mean that it's going to come down with a quickness. So a strong dollar in general, as we know, is a headwind not only to trade, but it's a headwind to those large cap corporations that have a lot of international revenue. And those big companies are the ones that have been the market story. And if you're a newer investor, those are also the companies that have really been the winners for you in the portfolio. So it's difficult to kind of shift your mindset. But I would encourage people that even in an environment like this, you have to think about maybe where the opportunities are, and they could be in places that you wouldn't normally look. So a strong dollar is actually very good for smaller cap companies because they get a majority of their revenue from inside US borders, so they don't have that headwind. So looking at things like that. The last thing I'll say about a strong dollar is that from a macro perspective, the signal that you want to see is that when the dollar weakens, that tends to mean that we're nearing the end of a tightening cycle or nearing the end of a hiking cycle. The fact that the dollar is still pretty strong here, I think means that the Fed continues to hike, and they right now don't have a ton of reason not to.
Particularly with such a strong labor market, as we've seen time and time again. And what's been interesting is on an anecdotal basis, you hear of startups and actually some big tech listed companies dialing back their headcount, looking to actually just slow hiring or indeed fire. Are you likely to hear, are you anticipating more concerns being voiced by CEOs as we're in earnings season? Because I'm not hearing it particularly from Satya Nadella or from, well, Ruth Porat or Sundar Pichai.
So if we look at the labor market just in particular, I would expect to see some weakness in it and see that coming through in the data. closer to the end of the year. So the labor market is one of the last things, if not the last thing, to turn when you have an economic contraction or a slowdown. And if you just think about that logically, there's a reason we're not hearing about it from CEOs, because they will do everything else they can to control costs before they have to actually lay people off and cut jobs. So what we're hearing right now is a lot of hiring freezes, and that's coming through in the data. So if you just look at the job openings or the JOLTS number that we got for August, job openings came down by 1.1 million. That was a huge drop. So now the ratio of the number of jobs open per unemployed worker is 1.7. That's down from 2. We used to have 2 jobs for every unemployed person. Pre-pandemic, that number was 1.2. So that gap still has to narrow a bit. The risk is that that gap narrows, and then we're in this kind of comfortable supply-demand place with labor. That's when, if we haven't slowed the bleeding, that's when you start to hear about layoffs. So we still have some time between now and I think that point, but I do expect it to start coming through in the labor data, see some weakness by the end of this year.
Ultimately, at this moment, Liz, with so much, you talking about 50% of recession, people thinking potentially is higher, with a lot of lack of clarity, is it time to put all that cash that people have been taking out of stocks, putting it into cash? Is it time to reinvest or keep powder dry for now?
You can think about reinvesting it. And look, nobody's going to call the bottom perfectly. And if they do, it's going to be lucky. So let's just all stop trying, right? But if you think about just where we are year to date, with an S&P still down 20% or so, 20 to 22% year to date, that's a better entry point than it was in January. So I would start to get ready on what's the shopping list, what are the sectors and the industry groups that you would be interested in buying, and drip in slowly. So in this particular moment right now, I would be looking at financials, because they're still very attractively priced compared to many other sectors. And they don't have a ton of pain ahead, in my opinion. I think they've been pretty punished through this cycle, and I think they can come out well on the other side. I'd be looking at industrials. And I've been talking about healthcare for a very long time. I think that healthcare is a great long-term investment. And then a little bit further down, and look, I think this rally is fragile, so I would expect another correction on the other side of it. If and when that happens and you see an S&P get back down to previous levels, so let's say something like 36, 3,500 or below, that's when you start to nibble on riskier things. You start to look at semiconductors, you start to look at tech again, and you start to look at other things that might be a little bit more high beta. And then later, even after that, when the economy really confirms that it's weakened, so when the labor market starts to fall apart, that's when you start to look at things like home builders, and you get back in on that train. You look at small caps in that environment as well.